Good morning, everyone, and welcome to Hein Associates Energy Webinar. I'm Jennifer Nichols, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted, so please use our chat feature to ask any questions. We will save time at the end for questions and answers. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive your CPE credit for this session, you must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course. A link to the webinar recording and presentation materials. Our presenters today are Jimmy Williams, Principal in the Transaction Advisory Services in the Houston office. Jimmy joined Hein's Transaction Advisory Services Department in 2015. With over 27 years of experience, he specializes in assisting companies, private equity groups, and lenders with all aspects of transaction services. We also have Jim Harden with us today, Principal in the Valuation Services in the Houston office. Jim serves as the firm's Business Valuation Services leader and is a principal at Hein. With more than 30 years of experience in the energy industry, he provides valuation, economic consulting, and litigation support services to public and private companies, investment firms, and law firms. And we also have Marty here with us, State and Local Tax Manager here in our Denver office. Marty serves as a State and Local Tax Manager in the Denver office. With over 8 years of experience, he provides state and local compliance and consulting services to public and private companies across a wide range of industries and regularly assists clients with complex income, severance, and sales and use tax issues. So we're going to start with our first polling question. What is your current position at your company? Owner, CEO, CFO, Controller, VP of Finance, COO, Consultant, or other? And with that, I'd like to thank you all for attending, and I will now introduce Jimmy Williams.
Good morning, everyone. This is Jimmy Williams with the Transaction Advisory Services practice here in Houston. What I want to do today is just kind of go through a quick overview of what's been going on the M&A activity in the marketplace. I think, first we'll kind of start off with, what's been happening in kind of the commodity price environment. I think obviously everybody's familiar with the fall that we've had since, the end of 2014 and continuing a bit into 15 and 16. But, it appears that we've kind of found a bottom and have recently had some recovery. So that I think that is probably, due to some changes fundamentally with, the demand starting to outstrip supply, and now we're kind of, it appears that we're starting to, go through some of the supply inventory that we have. So I guess the question from here is really, okay, now that we've potentially found a bottom, how quickly do things recover, and to what level do they recover? And looking at the strip, I think it's fairly flat through the end of 2017, and I think that's suggesting that we'll have a slight uptick in prices, but as what this market has been for a while, a supply disruption, could, have further spikes in prices. And, I think I think really what we've kind of seen in talking with various analysts out there is you have a number of industry analysts that are kind of predicting, kind of a 50 to 75 price range for 2017. So we'll see where that goes. But I think that we wanted to kind of cover that quickly because that's something that will, kind of we believe has been impacting what's been going on in the M&A market. This next slide, and I will tell you that all the numbers here are on closed transactions, and we've excluded power and utilities transactions. But what you're seeing here for the North America M&A market, we hit a peak in fiscal year 14 with 591 transactions, $283 billion in value. In 15, that dropped fairly dramatically down to $144 billion, and then we're seeing a further decline overall in year-to-date through April of 16 with kind of $11 billion of closed transactions. I think one thing that's, would be, we think that is impacting this a little bit is you look at the number of restructurings and bankruptcies that have occurred across 15 and 16 with, in the EMP sector, you've got, around 77, 78 bankruptcies that, have kind of a total of about $55 billion in debt. And then in the oilfield service sector, it's about 61 transactions with about $9 billion in debt. I think the other thing that's, I think has impacted the slowness of the M&A market is a number of these EMP bankruptcies have essentially come through as prepackaged deals where the subordinated and unsecured debt has been converted to equity and then with new first lien debt arrangements being put in place rather than having asset sales through a 363 process. So, kind of looking more forward in the transaction multiples, I think, I think what we're looking at is, we're seeing the multiples remain fairly constant, but given where we see prices moving, we'd expect to see, some further decline in the multiples going across 16. So next, I'm going to kind of briefly go through various sectors here. First, talking on the EMP side, you can see that we've got, fiscal year 14, 422 deals with $109 billion in transaction value. That dropped to $43 billion in 15, and year-to-date closed is about $7 billion. Of note, the recently announced Range Resources and Memorial Resources transaction, which is about $4.4 billion, is not included in these numbers because it's yet to be closed. But I think what we're seeing is that operators are looking for the ones with financial stability are looking for assets. However, there haven't been a significant amount of quality assets available on the market. So, our view is assuming that the oil prices hold consistent with the forward curve. I think there's probably still some additional restructurings that we're going to see, and really the question as to activity, I think, may be whether those restructurings, any of those result in asset sales versus the trend that's been happening so far, which has been primarily a capital restructure. Going on to the oilfield service market, I think if you look at the oilfield service market, as you would expect, this sector has been hit probably harder than anything else with the decline, especially with those that have services near the drill bit. I think the transaction value, transaction counts have plummeted from like 70 to 33. and then is a much smaller number through year-to-date 16. On the value side, I think the obviously the Schlumberger Cameron acquisition is $17 billion of the $19 billion in fiscal year 15, and thus from a value standpoint, it's pretty inflated by that large transaction. What we're seeing going forward for activity in 16 is you may continue to see some of these larger consolidations, such as the recently announced FMC Technip merger, which is about $13 billion, and others that are they're looking out there in the marketplace. But we still expect this to be a fairly slow year for this market space. Now, kind of going on to the downstream midstream sector, I think this has been a more consistent sector over this time period than either the E&P or the oilfield service side. With kind of a range of 80 to 100 transactions per year. In current year we were at 15 through April, and but a fairly small dollar value at $2 billion. I think that there's a recently announced transaction that with TransCanada's purchase of Columbia Pipeline, that's about $13 billion, that is not yet shown in the 16 numbers. With that, I think we'll be fairly in line with what we've been seeing over 2014, 2015. So with that, I wanted to kind of go into another polling question. So
in the current pricing environment, what is the biggest challenge your company will face in the coming year? Maximizing operational tax savings, debt agreement compliance, acquisitions and or disventures, or other? Okay, and now I'd like to introduce Jim Harden.
Thank you very much, Jimmy, and thank you for participating to everybody out there in this webinar. I just want to talk briefly about some of the valuation drivers that we're seeing in the marketplace right now. And I guess the first slide is the market value of equity. I picked on about 15 companies, large cap, mid cap, and small cap, and obviously there's a close parallel with the price of oil. But what I guess is interesting about this, and mind you, the companies we've looked at are just through 12/31/2015, but several of them are coming basically back to where they were in January of 2010. So this is kind of like the moonwalk. We've done 5 years forward and then 5 years back on the drop in oil price. So a lot of the companies that the equity that they built over the past 5 years have come right back to where they started from. The next slide is on the debt equity ratio, and looking at this, the debt to equity of the companies we've selected has gone from about 15% in 2010 up to about 35% debt to equity. And this isn't because they have necessarily assumed more debt, and obviously in the past 5 years a lot of them have. It is caused mainly by the erosion of their equity. And so we also work with some small companies that their debt equity ratio is north of 100%, and it creates some confusion in the valuation process of these companies. The next slide is the cost of capital and cost of equity, and this is really interesting. Now, mind you, looking at the cost of equity graph on the upper right-hand corner of this, we saw a cost of equity averaging in the 12% range for those companies selected 5 years ago. Now it's gone up by about 40-50% to around 16%. And mind you, we didn't incorporate any size premia or systemic risk premia in this, and that's kind of important because when you look across some of the comps we've selected here, you know, where's their chief asset? For example, a company that operates just strictly in the Bakken Shale or strictly in East Texas would have more systemic risk premia than a company that has operations in multiple locations, West Texas, Mid-Con, Marcellus, etc. So risk premia is typically associated with a single geographic footprint and a non, I'll say, broader regional footprint for the companies. And likewise, this causes a kind of a conundrum in that the cost of capital, which is the weighted cost of capital between the debt and the equity, has actually dropped. And the reason for this is because the amount of debt on a balance sheet is usually at a lower rate than the equity. So at cost of capital overall, and again, this is without any equity risk premium, was running about 10 to 11% in 2010. It's now down somewhere between the 8 to 9%. We know for a fact we've done work for a couple of these companies, and their actual street debt is trading at yields north of 14 and 15%, but on the books it's on at about 6.5, 7%. So the cost of debt is really important, and a lot of the debt, even the public debt, has much higher yields than what the book value stated. The other thing we look carefully at is the carrying value of the reserves. And on the graph on the next slide, you can see how that's reached highs in 2011 of upwards of $25 per barrel on booked reserves, and now down in the $10 range. And even for some of the smaller cap companies, $5 and less. So a lot of that is associated with the type of reserves and the type of I'll say, quality of reserves that the companies have. Before I move on from that, a slide that's not included, but we've done some analysis of reserve write-downs for the top 50 and 100 companies, and just picking on those top 50 companies, at least the ones that have reported reserve write-downs in the U.S. and Canada. And just briefly, in 2010, there was about $2.5 billion of write-down of those companies, a reserve write-down. 2011, $3 billion. 2012, $17 billion. 2013, $7 billion. 2014, $8.5 billion. And in 2015, there was over $107 billion of reserves written down. Through the first quarter of 2016, that's reached about $8 billion. So we think the end is in sight for at least the ceiling test shouldn't be as ugly over the next 2 to 3 quarters as they certainly were in 2015. I want to talk just a little bit about reserve-based lending. We assist some banks occasionally with redeterminations, and a lot of people call me and say, hey, we're getting a redetermination. A lot of people don't even really understand what it is. It's essentially when the banks rerun the reserves on their price deck and include the discount to the price deck. The RBLs, most companies have reserve-based lendings, and the redeterminations are typically done in the spring and in the fall, no one set date. And in fact, some banks are having their clients basically run redeterminations almost year-round now, and are forced to go back into their books and look at the reserves before there's certainly any second lien associated. So liquidity's dried up, and it's very, very difficult to get banks to lend on anything now beyond PDP and at a very, very conservative price tag. And so the banks are under pressure on the next slide. And I don't know if any of you have taken the opportunity to go out to the OCC, the Office of Comptroller of Treasury of Currency, which are the examiners, and download and look through their oil and gas production lending book. It's publicly available, and it has really tightened the screws on a lot of banks and their ability to lend to companies. So the handbook basically lays out guidelines. There's no steadfast or set fast rules. It's just saying here's how you need to look at your oil and gas loans, and certainly it's a constitution that the banks had not seen before. And at the bottom of that, I go into the increases and decreases in borrowing base. We believe that in 2016, for the remainder, borrowing bases are going to increase. There's some good forwardation in the market. Bank price strips should ease in the fall of 2016, and we're hoping to see prices in the $55 to $60 range by then, which will free up more capital for our clients. Finally, I wanted to talk a little bit about insolvency testing, and this is insolvency in this mythical zone of solvency has been under the radar screen a little bit. We've done a couple of solvency tests for companies, and not one of them was actually private and not public. And at the end of the day, there's two types basically of solvency tests. There's equitable, which is essentially balance sheet and looking at current debts and current liabilities, and it's a series of tests that, like, I don't know how many of you were in business school, but the acid test, the quick test, et cetera, it's the ability to pay off immediate-looking debt. The second type is balance sheet solvency. An example would be a company that has a decline rate, their reserves have a depletion or decline rate of, say, 20 or 25%, and they don't have capital to drill. They do have money to continue with G&A and other operations for the next 6 months or a year, but after that, things get very gloomy. So there's a good chance that company would not pass a balance sheet solvency test. In other words, the balance sheet solvency is it's an actual valuation. The main thing that boards of directors and company executives need to know is when they move into that zone of insolvency, their shift in responsibilities changes from that of previously to the shareholders and then to their lenders. And so that's a pretty big deal right now. I think we can move into the polling question.
If the equity value of an EMP company has fallen and the dollar amount of their balance sheet debt has remained the same, it's likely their cost of capital has increased, decreased, stayed the same, or depends on current cost of debt. Jim, would you like to go over the polling results?
Yeah, go ahead.
The responses show that the cost of capital has increased 21 responses, B was 13, and C 0, D 6. At first blush, the answer would be B, but the reality of it is it depends on the cost of debt. Because if your cost of debt has gone up, if companies have reissued debt at a much higher rate, and examples, a fairly big company here in town in Houston that hasn't filed yet, but they reissued their debt, which was originally at 6.5, I believe, and early this year they reissued it at 14.5, which is actually higher than their cost of equity. And so the answer is D. It depends on the current cost of their debt.
Okay, thank you. And then with that, I would like to introduce Marty.
Thanks, Jen. My name is Marty Cheetah. Again, I'm a manager in the Denver office in the state and local tax department. I work a lot on severance taxes, sales taxes, ad valorem property taxes as well for E&P companies and midstream companies alike. And what I wanted to focus on today are opportunities in the state and local realm for both severance taxes and sales taxes. And these are taxes that even if the company is at a loss position for financial or federal income taxes, they could still be subject and generally are still subject to these severance and sales taxes. And therefore, this is a timely item to look at, especially where companies would have had large expenditures during the past couple of years and have paid these taxes over the past couple of years, to look internally to see if there's opportunity to get additional refunds or to get cash back into the business. So I wanted to start with severance taxes first, and it is one of the most overpaid taxes in the oil and gas industry, generally for a lot of different reasons. The biggest is that many companies just think it's a cost of doing business. They think of it more like a sales tax, if you will, where we have a number of revenue that is brought in, we multiply it by the tax rate, and that's our associated severance tax effective rate. And that approach is not the right approach in order to end up with the right result. Most companies that do these severance taxes internally, what we've seen, some of them are using revenue accountants, accounts payable personnel, and other company personnel that just are not well versed in how these taxes work. With severance taxes in particular, in order to get a completed and correct severance tax return, companies really have to go through multiple departments within their company. We see them going through revenue, marketing, operations, finance. All of these different departments need to talk together, as there are many different overlapping items within severance taxes that are going to touch each of these departments. So if you let this compliance work with a non-versed personnel trying to complete this and they don't have the tools and the knowledge to work and complete these severance taxes correctly, generally most companies are overpaying severance taxes. And quickly, the severance tax ranges from around 4% to 35% of each dollar of production. So really bringing down that effective severance tax rate from even a 5% to a 3% can really have dramatic effects on a company's financial position, not just overall, but even on a well-by-well financial position. It can have a dramatic effect if you can even lower that effective tax rate by even 1 or 2%. So in order to find out what opportunities are out there for companies, particularly in severance taxes, it's good to come up with a base of how it's calculated. Many companies, when they go into different jurisdictions, we see that there's two main routes of how a state calculates severance tax and gets to the value that is actually taxable. The first one's a volumetric approach. This one's very simple. It takes the volume of production, so let's say a well produces 100 MCF of gas, and then it multiplies it by a statutory tax rate. Therefore, this one's a really basic calculation compared to the valuation method. The valuation, the most popular method of this, is called the netback calculation. So what the valuation method is really trying to do is trying to value the production at a certain location in operations. That's generally called the point of valuation. Sometimes we see this at the wellhead, the separator, the dehydrator. There's many different points depending on the jurisdiction that you're operating in. in each jurisdiction may utilize different points and different methods for different types of production, even from gas versus oil, and NGLs could even be treated in two different aspects depending on the location of production. So on this next slide, as I've talked about before, valuation is the more complex method, and by doing it that way, obviously there's more opportunity for refunds and overpayments that have occurred. There are generally three different ways that states accomplish this to accomplish valuing the production at a certain location within the operations. As I talked a little bit about netback calculation in that method, I will talk about that in a number of slides going forward, but first I wanted to talk about the comparable production method and the negotiated value. The comparable production method is used generally when you have a large operator or a large oil and gas company in a specific location, and that jurisdiction is trying to apply that same valuation method to other royalty owners or other operations within that same location. And this method is useful, however, it is sometimes hard to accomplish because each operator may have a different operations, they might have different contracts. However, the idea is if you're producing minerals or oil and gas from a specific location, that value should generally be the same across all operators and across all royalty interest owners. But again, this method can be flawed if there's other items going on within each operator's operations. The negotiated value method is kind of a last resort sometimes. We've seen this in a number of states. Particularly, we've seen one in Wyoming where we had an operator that was processing their own gas as well as processing other interest owners' gas, and the company and the department could not come up with a reasonable value based on the netback calculation or this comparable production method. Therefore, it was negotiated to a certain percentage of revenue, and then it was entered into a contract between the department and the taxpayer for 3 years. And therefore, it was established, and both the state jurisdiction and the county jurisdiction was able to rely on this negotiated value and not have to go into litigation in order to come up with a practical value of the production. This next slide, as I talked before, this netback calculation attempts to value product at the point of valuation. I said the separator, dehydrator, wellhead. And this is very important as I get to this next slide and showing you this graphic of a typical operation, where when we look at where this oil and gas is actually being produced at these wellheads, basically the second and third wellhead on the screen, this is where the oil and gas are actually being produced and severed from the ground. You know, at this point, there is a certain value to this well stream. It is not separated yet, but in some places, there might be a market for this well stream right at the wellhead. Where at the end of the operations, where we see the line going to gathering, this is the processed gas, the worked over gas that is actually going to interstate pipelines for sale. At that location, the price that a third party is willing to purchase that gas at is going to be a lot higher than if they were trying to purchase it right at the wellhead. And this is the difference between where we go with the point of valuation at the wellhead, depending on the jurisdiction, versus the point of sale, the actual cash that a company is getting for their production at the gathering point. And therefore, all of the equipment between the oil and gas production wellhead and the gathering line, and the gathering line out to the pipelines, all of that equipment could potentially be deductible. Therefore, you have many operators when they're completing their severance tax return, and not just operators, but also midstream companies and first purchasers that may be completing severance tax returns, they miss a lot of these deductions and a lot of this opportunity by taking deductions for compression, separators, dehydrators, flow lines, gathering lines, all of these additional equipment in between the point of valuation versus the point of sale. And therefore, it's important for companies to look at their equipment and to look at where they're actually selling and what price they're getting versus what the statutory point of valuation is. And as I said before, that could be at the first production separator, that could be at the wellhead, or even as far down as the at a dehy unit. and therefore it can be very different for each jurisdiction. And as I mentioned before, I said that a E&P company or an operator company usually files their severance tax returns, but that's not always the case. Sometimes we have midstream companies or first purchaser companies filing severance tax returns on behalf of the operators. In some locations, in some jurisdictions, this is optional. And sometimes the best practice is for the actual operator to file these severance tax returns. Now, why is that? The first reason is the midstream company, yes, might be able to accomplish this severance tax return, get it complete, have the revenue numbers, and are able to file it timely, and it would be more cost effective for them to do it than the operator itself. They don't have to staff the severance tax return. But the issue with that is the first purchaser does not have the knowledge of the operations of that E&P company, and therefore they could miss a lot of these extra deductions. The midstream company could also, they don't have a piece of this taxes that they really have to incur. Generally, it's reimbursable back to them. Therefore, it is best practice that we see is for E&P companies to really take over their own severance tax reporting in order to capture these deductions that I'm about to talk about, as well as additional exemptions and credits that are available. So these deductions, again, it really depends on where this point of valuation is to see what deductions are available. Certain deductions, for example, extraction costs, maybe using gas lift, water hauling, all of these other costs generally are not deductible, as they're a cost of producing and not a cost that actually adds value to the oil and gas once it's severed. And therefore, it's important to realize that, for example, a piece of equipment like a compressor could be deductible, and it also could not be deductible depending on what that compressor is actually doing. And therefore, as you have preparers completing the severance tax return and they see a compressor on their fixed asset sheet, they might have to go to the operations to see, what is this compressor really doing? Is it injecting gas for gas lift? Therefore, this compressor may not be deductible. Is this compressor actually pushing the gas down to an interstate pipeline? Therefore, then this compressor may be deductible then. So it's very important, as I said, to look and to deal with all of your different departments and to really ask to see what this equipment is doing. Now, deductions that we do typically see, for example, the compressors, separators, DI units, gas processing plants, trucking costs for oil, gathering and pipelines, those are generally all deductible, but again, it depends on the state and jurisdiction. We see these in a number of different forms for companies to take. The first is a third-party expenditure. So if you're filing a severance tax return and you're paying a third party to process your gas or transport your gas, this third-party expenditure would generally be deductible right off the invoice itself. Now, if the same E&P company would use their own equipment and use their own equipment, their own pipeline, or their own compressor and their own pipeline, the same deduction is really taken, although it's taken in a different form. That's generally taken by depreciation over the life of the asset and also the operating expenses that are incurred. For example, labor, insurance, fuel use within using that compressor. Another piece is the owned asset ROI. This recent case in Colorado came down within the last month, and this case really looked to BP, the company submitting this case, was do they get a return on investment, or really the cost of capital that incurred when they were trying to get deductions for a plant that they owned. The company was already getting depreciation or a return of investment, but they felt that a return on investment was also valid, as any third party that would own a plant would generally not only just charge you depreciation and operating expenses, but they would also charge a certain amount of return on investment or a certain amount of profit in order for them to stay afloat. No company would come in and do a processing plant not in it to make money. And therefore the courts looked at this, and it wasn't just a make money type standpoint, but what is the associated cost of capital and the opportunity cost where the BP could have spent that money elsewhere. And therefore the Supreme Court of Colorado decided in the taxpayer's favor. Now, who does this really affect in Colorado? It could affect any E&P company or any royalty interest owner that actually owns their own assets. So anyone with a processing facility, separators, tanks, anything like that could potentially count for a return on investment. Within the case itself, it did not address how to calculate this deduction. Rather, there are really two schools of thought on how to calculate this deduction. The first is to follow the NERC calculation, which is done for reporting ad valorem property taxes for real property in Colorado. And that is simply the undepreciated value multiplied by the BBB bond rate. The other approach is to use federal royalties, the federal royalty approach, which is again very similar. It's the undepreciated value times the BBB bond rate times 1.3. And therefore, using the federal approach could potentially provide an extra 30% deduction for the ROI. Again, this has not been addressed by the department just yet. They're still trying to quantify the amount of refunds that they could potentially have. There are estimates all the way up to $900 million of refunds that Colorado may have to pay. That seems a little high to us, just because when we're dealing with Colorado, we have a 3-year statute. However, if there are any other claims beyond that 3-year statute, those could also potentially be honored. And we've seen a lot of companies, and specifically in Colorado for 2015, that have a 0% effective rate due to the massive ad valorem tax credit that they're receiving. So as I jump to this next slide, we can talk to some of the exemptions that are offered for severance taxes. And there are still many jurisdictions that are offering very lucrative exemptions for oil and gas companies located and operating within their specific jurisdiction. And these exemptions can either reduce or eliminate the tax rate altogether. Now, an important tip on this is to realize, are these exemptions, do we have to certify the wells? Are they statutory? When do they come into effect? For example, to certify the wells, specifically in Texas, they offer a marginal well or a stripper well that a company has to go in and certify that well with the Railroad Commission, and then they can take a reduced rate, depending on the price of gas or oil for that particular month, on their severance tax return. Therefore, an action needs to be done by the taxpayer itself. Other states, like Colorado and their statutory, the stripper well exemption is actually written into the statute itself. Therefore, the exemption could be taken on the tax return, and no further action by the taxpayer needs to be done. Both of these, Texas and Colorado, are really done on the severance tax return itself, and once you certify these wells, you can take it, especially in Texas. However, Texas also offers taxpayers to go back and certify wells in the past. Generally, there's a small reduction in the benefit for the exemption. Other jurisdictions, like Louisiana, generally force taxpayers to get wells certified, and then only from that point do they actually get to reap the benefits. Therefore, it's important to realize which state you're operating in to see, should I be qualifying and getting these exemptions approved right now, because I will not be able to go back in time and get these approved. As I talked about the marginal wells, commonly referred to as stripper wells, Texas and Colorado both offer similar items as well as Utah, but the amount of volume produced can be vastly different. Both of these states are really trying to say, this well is just not producing at a level that is profitable, therefore we will provide a small break to taxpayers. The amount of dollars generally aren't that big, but for example, in Colorado or Utah, where you're dealing with 15 barrels of oil a day, if we're dealing with $100 oil, then we could get $300,000 basically of production and not be taxed. So that could be a significant amount of revenue coming into the company that is not subject to severance taxes. So as I jump to this next slide, other exemptions that are offered, the first exemption is exempt entities. So government entities, Indian tribes, we've seen companies that are completing their severance tax returns and they still have their their ONNR royalties within their severance tax reporting, and therefore they're actually paying taxes on behalf of the federal government, when generally this is going to be exempt production. So finding out who your owners are in your decks making sure that's all locked down and then providing that information to the severance tax preparer is pivotal in order to get the correct answer. Other exemptions that we see are, example, lease use gas. Some lease use gas would be deductible, while other lease use gas would not be deductible. Again, with the compressor example, a compressor that is using lease use gas to re-inject generally would not be would be non-deductible. However, lease use gas to run a compressor pushing that gas down the pipeline would generally be deductible, and therefore it should be looked at to see how you're using that lease use gas. We see this a big issue in Texas, where lease use gas is taxable and you can go in and then take the deduction for that lease use gas. Another thing to be aware of is that ad valorem tax credit in Colorado. This generally brings down the effective tax rate for taxpayers in Colorado from the statutory 5% all the way down between 1% and 3%, depending on the price of production in prior year, this year, and the operations. Therefore, if a E&P company is doing a lot of drilling, an ad valorem tax credit is not allowed in that first year of production, and therefore those new wells in Colorado are going to be an effective tax rate of 5%, less any amounts for stripper or deductions. So we see that a big issue when E&P companies, hopefully when we ramp back up in production, that they get hit with a high severance tax effective rate, where generally they've seen it more at the 1 or 2%. So something to be aware of as we hope production comes back online and get more rigs. Other opportunities that we see for credits and reductions of rates are really operational based. So if we're going in and recompleting wells, or if we use high-cost gas wells in Texas, or for example, if we have inactive wells for 2 years and we go in and recomplete or work over and those wells are now producing again, we could have substantial savings in severance tax. Some jurisdictions even provide exemptions for new wells and could even exempt the first 24 to 36 months of production, where these wells are going to have their highest production amounts in those first couple of years. And therefore, really looking at the jurisdiction and seeing what they have to offer is important. And as I said before, these jurisdictions are still offering these credits and exemptions. So nothing to write off because it could result in substantial savings. So the next slide that I wanted to get into are actual sales tax opportunities. And sales taxes are one of those most complicated taxes that we see in the state and local world. And the reason behind that is there's so many different jurisdictions, state, federal, county, special districts, that a lot of these companies are really trying to comply with, and it could be ultra complicated. For example, in one location, we could have a compressor or separator subject to tax, but then if we go even across the street in the same jurisdiction, that compressor or separator might actually be tax exempt. Another reason that we see it's complicated are vendors don't understand the tax law, and therefore their default is always to charge sales tax on any equipment that they're selling or for services that they're performing. The reason behind that is just a conservative approach. The oil field services and equipment suppliers and vendors, they'd rather charge the tax and have the purchaser go back and either get the refund or the vendor to go get it. They just don't want to be left out there if the purchaser goes away, or they could be subject to paying the tax on the equipment if the state comes back after them. So most vendors are going to be very conservative and charge tax. So it's important to really look at your expenditures, see if there's tax charge, and on the flip side, should there have been tax charge as well. We see this more on the use tax side when you have out-of-state vendors that will come and deliver equipment into the state. They may not have a sales tax reporting requirement within that specific state. Therefore, that vendor will not charge tax. Well, that liability actually is shifted and focused on the purchaser, and they must file use tax and pay use tax on that equipment. And as we know, use tax is one of those least complied with taxes in the United States. We've seen it even with Amazon laws, where people would buy TVs and other equipment offline and they would never have to pay sales tax on it. Well, technically, all of those purchases should have an accompanying use tax paid to the state of where that equipment is actually used. Therefore, if you're seeing items that you're purchasing that do not have tax included on it, it's best to really look and see what the purchase was and seeing if the company should have remitted use tax with that purchase. So some of the items that sales tax refund claims may be filed on, a lot of it's more based on manufacturing equipment. In specific states, they expand manufacturing to include oil and gas or extraction purposes. Some other states really look to having a chemical change in the product. As you probably could guess, manufacturing term is widely used, but it's multiple meanings across different jurisdictions. So when we look to what could actually be refundable, separators, tanks, ECDs, pipeline, casing, really depends on where that jurisdiction is and sometimes what that equipment is actually doing as well. So this is not just an equipment purchase item. It could also be non-taxable services where we have blended services done for E&P companies. For example, fracking, there is a large case, Noble Energy, where Noble wanted the proppant, the sand in a fracturing service to be exempt. They didn't really want to buy sand. They didn't want to buy ash. They didn't want to buy services. What they wanted is a fractured well. You know, a simple example of this when we deal with E&P companies, to give them an example, is if an E&P company or any company wanted to have a hole in the ground, they could either go and rent an excavator and pay sales tax on that short-term rental generally, or they could contract that out and the construction company would bring an excavator out and bring an operator, and therefore that transaction may not be taxable because what that transaction really represents and the true object of that transaction was I wanted a hole dug in the ground. Nothing tangible was given between the purchaser and the vendor. So in this expenditure, you could have two expenditures trying to accomplish the exact same thing, a hole in the ground, but the tax implications could be very different. Other non-taxable services that we see, again, depending on the jurisdiction itself, could be cementing, fishing, all of these items where an operator is really using the tangible equipment, even though they might, on their invoice, they might be trying to charge tax for it as far as a short-term rental or materials that are consumed in providing the service. These are certain services that companies need to look at. And what is the timeline for sales tax refund claims or even severance tax claims? Generally, again, we see a 3-year statute. However, it could be all the way up to a 6-year statute, depending on the jurisdiction. Some of these statute limitations or the opportunity for refund or assessment could fall off on a monthly basis, while others could be quarterly or even yearly. One important item that a lot of people are asking are M&A activity and the sales tax impact, especially where we have companies that are buying assets in different jurisdictions. Is there a sales tax implication, especially where we're seeing a lot of companies that are trying to assign a 10 to 20% value to the tangible personal property associated with it and the remaining going to reserves? It depends on the location. In Texas, they offer an occasional sale rule, which generally can exempt a lot of this equipment from sales tax, especially if it's in its own department or if its own operating activities. Therefore, this could be exempt from sales tax. In other states, the occasional sale rule is not present, and therefore selling assets and doing a divestiture might be subject to sales tax at 10 to 20%. How companies get around this is generally they do a dropkick method with a single member LLC. So the seller will take all of the tangible personal property reserves, drop all those assets into a single member LLC, and then the buyer will purchase the stock of this single member LLC. This really makes the transaction a purchase of intangible assets, which are generally not subject to sales tax, even though within that company we have tangible personal property. And therefore, if you have both a buyer and a seller that can agree to this situation, it could be beneficial for both companies to approach this transaction in that way. Again, it doesn't work for every single jurisdiction, but is something to be aware of, especially if there's activity going on in certain jurisdictions. That's what I really wanted to cover for sales tax. We're going to jump into a quick question here. Jen?
Where are your operations located? Wattenberg, Eagle Ford, Bakken, multiple locations, or other foreign?
Okay, we're going to go over the results. Generally, what we mostly see is multiple locations. We're all over the place. We're seeing not a lot of activity right now for the Bakken, at least on this call, but perhaps some of that is just due to the multiple locations.
Okay, thank you to our presenters. We're going to open this up for question and answers now. We've got several questions. The first one, how much of the M&A in 2016 is in the EP sector?
So I think of the EMP closed transactions, what we've seen to date has been about $7 billion of the $11 billion has been in the EMP sector. And, obviously that number will jump up, with the $4.4 billion transaction that was announced between, that we mentioned earlier between Range Resources and Memorial Resources.
Okay, and then this is kind of, I think, a second part to that first question. I wonder whether you have broken down the M&A or restructuring deals per basin or per region.
Yeah, for the closed transactions, we have the data. We haven't shown it, and I don't have it right at the top of my fingers, but the transactions have focused in the Arklatex region, Mid-Continent, then probably the Rockies and the Permian. And as you see, most of these transactions are getting done in the lower cost regions at this point in time. And I think we should see that continue to be the focus of transactions is focusing where there's lower cost.
Okay. What is the biggest challenge in valuing an oil and gas company, and what makes it different than valuing an M&D or technology company?
Well, obviously, the volatility today in prices and just kind of reiterating what I talked about a little bit ago, just step by step, one is calculation of a correct discount rate because we're not in a PV10 or PV9 world anymore. And determining what the proper discount rate would be. Secondly would be the price, either the confidence level in using a NYMEX strip has eroded, obviously, because I calculated last year it's more than 30% wrong, more than 70% of the time. So you wouldn't take those odds to Vegas. And thirdly is the capital expenditures and whether or not a company has the financial wherewithal and resources to promote PUDs to PDPs, even PDNPs, and bringing them online, and that's been a big challenge. So, I guess the answer is everything. We've been doing a lot of valuations for allocation of purchase price on upstream deals, and to use the word digging for value and trying to find the value for book accounting purposes has been interesting, to say the least.
Okay. What kind of valuations are you seeing for distressed in default OFS companies?
Yeah, and this is it's a pretty interesting question because I think when you look at a lot of the distress, let's say the companies first that filed for bankruptcy, what we're seeing is a trend in a lot of these companies because of lack of assets with value, that they're restructurings that are turning into liquidations, and not a significant amount of value on the assets. When you look at, I'll say, other distressed companies that have yet to file, the hard thing, it's not the trailing 12 EBITDA, because people are looking at trying to look at what's the backlog, what business do they have going forward, and obviously that's when you get further away from the drill bit, there's still service work being done there. Those closer to the drill bit with little backlog, it's been fairly distressed on those valuations, and the multiples, and what multiples they're using, i.e. is it a trailing 3, and then something based off of the backlog going forward. So it's certainly been a significant downward trend. I would say they're getting closer to a 3x than up in a 5 and 6x.
Okay, do SALT calculations come into play for non-op partners, or does the burden of calculating and applying for benefits lie solely with operators? Sorry, guys.
Again, this question, it depends on the jurisdiction. In certain locations, in certain jurisdictions, each royalty interest owner must file a severance tax return. That, for example, in Colorado, where we have other jurisdictions where the operator files severance tax returns for all interest owners, and then is able to sometimes charge this back to the interest owners, and therefore sometimes in JIB audits, this is looked at to make sure that this is generally done correctly. So again, it really depends on the location and the jurisdiction that the company is being operated in, but in certain locations, the non-op partners are allowed to take deductions that they incurred and have to complete their own severance tax return, and therefore reviewing the exemptions that are done on a non-op basis can really save those royalty interest owners money.
What is the process for submitting refunds in severance and sales and use taxes?
The process, even though they're vastly different taxes, sometimes they're very similar. The process to get these refunds, it usually starts with some type of kickoff meeting with the taxpayer to really understand their operations, to do some initial scoping to see if there might be any opportunity there. If there is opportunity identified, then it really goes into a different phase where interviews are done across multiple departments within that organization, review of the calculations that were previously done, fixed asset scrubs, even marketing interviews are important. The timeline for these type of refund studies, it really depends. Certain jurisdictions do not have a statutory requirement to reply to a refund claim, while others must reply within a certain timeline. Additionally, the massive amount of data that's required to complete these refund studies can really slow down a refund process. Just preparing that refund could take several months to do with the total amount of data coming in, and therefore it's important to be aware of your statute of limitations. As you do not want to be caught finding that your statute of limitations expire in a week and you haven't even started this review process. Certain jurisdictions do allow quote-unquote protective claims, where if a taxpayer realizes that there's an overpayment of tax, they could submit an estimated or a protective claim, and then that claim is then perfected as more data is acquired and more documentation is submitted to that specific jurisdiction. So in some cases, that could be an option. In other jurisdictions, a completed return or completed claim for refund needs to be submitted, or the department will deny and say it is an incomplete claim, and it is the burdens on the taxpayer to get that claim in as soon as possible and complete it. We've seen claims that are sometimes paid within a month or two. Other claims have drawn out for years, depending on the jurisdiction, and the issues at hand. When we see these reviews done, it usually goes through an initial audit and an initial review, and then it goes up the chain of review from a tax conferee position, an executive to director position, and then we get into generally courts where we'll run into a district, court of appeals, and then even the Supreme Court for that specific state. So we could see some refund claims that take years. For example, that BP case, the years in question were actually, I believe, in 2003 and 2004, and it was finally settled this year. The amount of money per year, it was around $600,000 per year. So the interest that's going to be paid on that principal is going to be much more than the principal, even 2 times the amount of principal that was applied for. So yes, it did take a number of years, even 12 years. However, that's not very typical when we see these refund claims submitted. So again, it depends on the jurisdiction and how this process is done. But just due to the vast amount of data, it could take some time in order to get the information to submit the claim. So be aware of those statute of limitations. You do not want to be caught off guard that statute's coming and you do not have anything prepared for that.
What do you expect the impact of the breakup of Motiva will be on downstream M&A activity?
I think the one is Saudi Aramco with getting one of the facilities and then Shell getting 2 others. I think it's been something where Saudi Aramco has said that fairly publicly that they're going to be looking for incremental U.S. refineries and or chemical plants. And so, hopefully what we're going to start seeing is an uptick in the activity there on the downstream market, along with some of the majors selling off of some of their smaller refineries.
What trends have you seen in the lower middle market section of the OFS market?
Yeah, this is a pretty interesting question because I think, from everything that we have been seeing in the marketplace, the majority of these lower middle market oilfield service transactions have been shelved for the time being, and a portion of that is probably due to kind of a difference in valuation between the sellers as well as the buyers, and and hopefully what we're going to and then couple that with most of these smaller oilfield service companies, their backlog has been dwindling, and or the quality of their backlog has been hurt by a number of the things going on the EMP side. Hopefully what we'll start to see is as the prices start to trend up, maybe some fairly significant lag in time frame before their backlog starts to come back, but we'll start to see more activity in those transactions. But year to date, it's been very minimal because of the factors we talked about there.
Okay. Have you seen a significant number of 363 sales arising out of OFS bankruptcies?
Actually, I think we touched on this a little bit earlier, but I think it's an important part is, most of these bankruptcies on the oilfield service side, there have been a number of these that are, I'll say, restructurings going into liquidations because the lack of backlog for those assets. There have been a few 363 sales where people are being opportunistic in picking up some assets that work for their business, but there have been the 363 sales have not been as large as we would have expected, and I think that's due to the length of this down cycle.
Okay. Thank you, Jimmy, Jim, and Marty. That's all the time we have for questions today. Please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you all very much for attending today, and have a great day.
Thank you.